This is flip video 4.3, banking and money creation. So we learned a little bit about banks and what they do in our financial assets lesson, but just a quick review of what they do here. A bank is a financial intermediary that uses bank deposits, so that's our checking accounts or our liquid assets, to finance borrowers' investments in businesses and homes, the illiquid assets. So remember, liquidity is how quickly something can be converted to cash. So our bank deposits, which are the checking accounts, are already cash. Those are already liquid. And then our investments in businesses, so that's like physical asset purchases, and then of course purchasing homes, those are all illiquid. We can't just like turn around and turn that into cash. So our banks hold bank reserves, which is current money that the banks hold in their vaults, plus deposits at the Federal Reserve. So our bank has reserves. It's the cash from our checking accounts that they hold in their bank, and then it's also bonds from the Federal Reserve. Typically, banks hold on to some portion of their deposits and then lend out the rest. And this lending out the rest is what's actually going to create money. Loans creates money in our fractional reserve banking system. So the reserve ratio is the fraction of bank deposits that a bank holds as reserves. So if you think back to flip video 4.1, this is also one of the tools of monetary policy is the reserve ratio. So our banks have to hold a certain amount of money in the vault at all times. And that percentage is called the reserve ratio. The required reserve ratio is set by the Federal Reserve and tells the banks this is how much you have to keep in your vault at all times. So banks are regulated. There's 4 methods of regulation for our banks. First is deposit insurance. So the FDIC guarantees up to $250,000 per account if a bank cannot meet its obligations. So a bank cannot meet its obligations means it runs out of money or it loses your money. So FDIC insurance guarantees protection of up to $250,000 in your account. If you have money over that, that's not going to be covered by FDIC insurance. Banks are also required to hold capital. So this makes banks hold more capital means when losses incurred when loans go bad. So if a loan does go bad, so you take out a loan from a bank, but you can't actually pay it back, this goes against the bank instead of against our government insurers. So like AIG is a big government bank insurer. So the loans are actually like faulted against the bank instead of government insurers. We also have our reserve requirement, which again is from the Federal Reserve System. So this is the amount of money they have to keep in their vault at all times. And then we also have a discount window, which allows banks to quickly borrow money from the Federal Reserve in an emergency. So if there is an emergency, if there is a really high rate of cash withdrawals or loans that need to be issued from a bank, banks can use the discount window to borrow money from the Federal Reserve directly. So a bank run can happen. We haven't had one in a while, but they do happen. Banks usually lend out most of their funds deposited with them because only a small fraction of depositors want to withdraw their funds on any given day. So think about the amount of times just in the last few months that you've actually gone to your bank and withdrawn cash from your account. It's probably been a while. I honestly cannot remember the last time I got cash out of my checking account. So banks lend that money out. Now you still have all the money in your checking account, but that cash that you've deposited into that bank is now going to be lent out to someone. So they lend out the majority of that money because the depositors, so people who have checking accounts at banks, don't really withdraw all of their cash in one day, nor does everyone that banks at a bank withdraw their cash on the same day. So bank run occurs when many of a bank's depositors try to withdraw their funds due to fears of bank failure. So a bank failure happens when the bank cannot meet all of its obligations to its depositors. So obligations is just they're running out of money. So yes, you still have money in your checking account, but you can't get it out of the bank. So if you hear that your bank is losing money or doesn't have your money, you're going to panic and you're going to show up at your bank and be like, hey, I want my money. And if everyone's doing that at the same time, then that bank's going to run out of money. And this creates a bank run, which then can lead to a bank failure, which means it literally runs out of money and people are panicked and there's just no way to, create withdrawals for all of these people. So banks do create money. So our fractional reserve banking system is how banks create money, and it's part of this multiplying effect we've talked about before with our government spending multiplier and our tax multiplier. So how exactly do banks create money? Well, they create money through loans. So when you deposit $100 into a bank, that bank can now loan out that $100 to someone else. So you give the bank $100, they mark it in your account, and then they're just going to turn around and hand that $100 out to someone else as a loan. Now you still have that $100 in your checking account. If you look at your bank statement, you'll see the addition of $100 and it's still there. But that bank is now able to create a loan with that cash deposit. Now notice, nowhere in this little scenario here does it say the bank printed money. They only loaned out a deposit, so they're only loaning out money that has already existed. So only the U.S. Treasury can mint or print new physical money. This bank did not print any money. All they did was take your deposit, mark it as plus 100 in your account, and then they just turned around and handed that $100 as a loan to someone else, therefore creating money. You have $100 in your account, it's still there, but now someone new has a new $100 to spend. So how does this happen? So when you deposit your money into your bank, that entire deposit goes into the bank reserves. So you give the bank $100, now the bank has had an addition of $100 to their bank reserves. And our bank reserves are broken into two categories. The required reserve, which is the money that goes into the vault and cannot be loaned out. And this number is the reserve ratio that the Fed sets. And then the second category is the excess reserves. Now the excess reserves is money that is able to be loaned out. So anything that goes into the excess reserves turns into loans. So banks will take any money in their excess reserves and turn those into loans. And those loans are now deposited into people's accounts, into other banks, whatever it might be, which then create more excess reserves, which are then turned into more loans, and it's a constant multiplying process. So to figure this process out quickly, like how much can a $100 deposit into a bank, how much money can that create, we will use our money multiplier. So it's the same idea as our spending and our tax multiplier from fiscal policy. It's this multiplying effect. So our money multiplier equation is 1 over the required reserve ratio. So if our required reserve ratio that's set by the Fed is 10%, that's going to be 1 over 0.1, which is 10. So the same kind of math from our spending and tax multiplier is 1 over our decimal, which gives us that whole number. So bank deposits have to have the required reserve taken out prior to calculating the change in the money supply. So when you deposit money into your checking account, the bank has to pull the required reserve ratio out of that deposit and put it in the vault. Then the rest of that money will go to the excess reserves and create a loan. But if the bank is buying and selling bonds from the Federal Reserve, then they're not going to take out any required reserves. It's just the full bond transaction that they're going to use the money multiplier for. So these are our change in money supply equations. So you want to make sure you write these down. So the change in the money supply using our bank's deposits is change in the money supply equals the excess reserves times our money multiplier. And then change in the money supply equation using bonds is bonds times the money multiplier. So you want to make sure that you write down these equations. So here's some quick practice with those equations. Suppose you deposit $100 into your checking account. If the bank has a 10% required reserve ratio, what is the change in money supply? So we're depositing $100. So remember, deposit, we have to take the required reserve ratio. So we have to take 10% of this $100 and put it in the required reserves. So 10% of 100 is $10, which means we're going to get $90 to go into the excess reserves. So, and then our money multiplier is 1 over the reserve ratio. So 1 over 0.1 is 10. So now let's look at our change in money supply equation. It is the excess reserves times the money multiplier. So our excess reserves is 90, money multiplier is 10. 90 times 10 is change in the money supply is an increase of $900. So if you deposit $100 into your checking account today, you're going to create $900 of, quote, new money, not newly printed money, but new money that's going to flow throughout our economy. So now let's look at a bond purchase here. Suppose a bank receives $100 worth of bonds from the Fed. The bank has a 10% required reserve ratio. What is the change to the money supply? Remember, we're not going to take the required reserve out of the bonds. Bonds get the full power of the money multiplier. They're much stronger to change the money supply than deposits. So our money multiplier equation first is going to be 1 over the required reserve ratio. So 1 over 0.1 is 10. And then our change in money supply equation is bonds times the money multiplier. So I'm going to have $100 worth of bonds times 10. So that's going to be 1,000. So change in the money supply is going to be $1,000. But we need an increase or a decrease. So if the bank receives $100, does that sound like the Fed bought or sold bonds from the bank? Well, is this the Fed buying bonds? So remember, bonds is just a piece of paper that says, hi, I'm worth X amount of money. So if the Fed is just buying the pieces of paper and the bank is getting $100, we're adding money to the money supply. So this will be an increase of $1,000 to the money supply. So you can see the bond purchases are going to be a lot lower. The deposits are going to be a lot lower to changing the money supply versus our bond transactions of changing the money supply.